Hello and welcome to another Deep Valley video. Today, taking an in-depth look at UnitedHealth Group Incorporated, ticker symbol UNH. We invite into the financial metrics, assess the company's growth, and ultimately try to find fair buy price. UnitedHealth Group Incorporated is an American multinational health insurance and services company based in Minnetonka, Minnesota, selling insurance products under United Healthcare and healthcare services under the Optum brand. The stock is priced at $598 with a market cap of 552 billion. Now let's dive into some key valuation metrics. The price to earnings ratio stands at 22.6 and the price to cash flow ratio is 57.5. The median PE over the past 10 years was 21.4, so the stock is trading near historical levels. Over the past 5 years, the company's revenue has grown by 53.4% and its bottom line has increased by 61.7%. In terms of earnings per share, there has been a growth of 66.8%. Notably, the number of common shares outstanding is 932 million, a minus 3.5% change over the period. Now, let's assess the company's liquidity and solvency. The interest coverage ratio is 9.16, indicating the company's solid ability to handle its debt obligations. The quick ratio, a measure of the company's short-term liquidity, is 1.32. This suggests that the company has a solid hold on its short-term liquidity and is ready to resist shocks. Additionally, the long-term debt equity ratio is 0.72 and the total debt to equity ratio is 0.72, both showing a moderate debt load. Um, Shifting to the cash flow statement, cash from operations stands at 29 billion, reflecting a growth of 57.4%. Cash from investing activities is minus 15.5 billion with a plus 22.6% change, while financing activities are minus 11.5 billion, showing a 104.9% increase over the same period. CapEx has also increased by 63.4%, and free cash flow has grown by 31.2% to 21.8 billion. Moving forward, let's look at the return metrics to see how the company is utilizing its resources. The return on equity is 15.2%, the return on investment is 20.8%, and return on assets is 5%. The return on invested capital is 8.7%, which is pretty good, but not extraordinary. Finally, let's find the acceptable buy price. The first method is conducting a discounted cash flow analysis. By using a discount rate of 10%, a revenue growth rate of 7.5% for 10 years, and a perpetuity growth rate of 2%, we get a fair value of $484.3. Secondly, using a multiple variation of 30 times earnings, operating cash flow, and 25 times free cash flow, we arrive at a fair value of $448.7. Finally, the analyst target price is $629. Putting it all together, we arrive at an intrinsic value of $520, and of course, using a 15% margin of safety, we get an acceptable buy price of $442.5, suggesting that the stock at current levels is overvalued. To wrap up my analysis, I rate United Healthcare Group as a whole. Now, as for a personal commentary, I'm not really an expert on healthcare stocks, especially US. I'm not from the US, so I do not understand their system. But this, at least from a macro perspective, seems like a very well-run company. They have a great balance sheet. They have good growth. They have moderate long-term growth perspective. Uh, this is it's a very well-run company. Not extraordinary, but very well-run company. That is a bit pricey. I mean, I believe that at least their price to cash flow is a bit worrying, and their premium to their discounted cash flow is also a bit high. If their price drop to sub 480 levels, I think this would be a great buy. Now, of course, the round due diligence in if you are from the US and you are in the healthcare system, maybe you know a little more about their future prospects or something. I don't know, but at least from a macro perspective, from the balance sheet, income statement, cash flow statement, they seem like a very good company. So I think this would be a great buy under 480. Thank you for watching. If you found this video helpful, please like and subscribe for more deep analysis. See you in the next video. Bye.